Welcome back, guys. Just 2.5 hours to go and we'll get to know what's on the finance minister's mind. For now, the SGX Nifty is indicating the start will be in the green. Remember, yesterday was a really strong day and we had big delivery-based buying and a lot of banking names, the likes of Axis Bank, etc. But Mohammad Appabai, Asia Pacific Trading Strategy Group Head at Citi, and Yu Young, the MD of Aberdeen Asset Management, join us now to give us their view on what to expect this time around from the budget. Gentlemen, morning to both of you. Mohammad, I want to start with you. What would constitute a dream budget for you this time around, and what would be a disappointment?
Well, I think something which is focused on fiscal prudence, I think, is what foreign investors are really looking for. We are in an environment of tightening global liquidity, so the Indian bond markets will be looking for funding and competing with funding. Or competing for funding with, in competition with a lot of the other markets as well. So really, any improvement on the numbers would be very welcome. I'm not really sure we're going to be getting that in the same way. But of course, what the Fed has done has improved the tone a little bit. So that is definitely a lot more positive. I think the one thing we would caution, though, is that all that has happened is that the Fed has changed the language and the tone a little bit, but the central bank balance sheets are continuing to shrink. And until they start expanding again, it's going to be difficult to call the green light on risk markets globally. Okay.
Aberdeen, of course, is one of the largest foreign investors in India. We have Yu Young also joining us. Hugh, good morning. Thanks a lot for joining us. Over the last 2-3 years, India has fallen off the ranks in terms of the FII investments. Do you think it could make a comeback once this budget is over?
Oh, I mean, the story of India is certainly not over, far from over. So long-term for investors like us, it's a great place to go. I mean, I think the issues have been shorter-term issues, and for us, short-term can be as long as 3 years, I'm afraid. So the issues of the market a year ago were ones of valuation and lack of growth coming through on the corporate front. And we have some short-term concerns now, of course, because as has been correctly said, foreigners are looking for fiscal prudence. I suspect we're unlikely to get that in the budget, so we'll get more subsidies for the farm sector, maybe tax cuts. And the budget might well be, well, let's see, but might well be a political budget preparing for elections and trying to regain the prominence of the BJP. And that's not necessarily what sort of prudent fiscal policy should be, but it's a reality of the world, and it's happening in every country at the moment. Populism is widespread.
That's a fair point, Hugh. I'm just coming to you. Let me ask Mohammad about these fiscal numbers itself. You know, Mohammad, surely there is going to be a populist budget, but it's coming at a time when crude is at, close to $60. Not a big fiscal worry or a current account deficit worry for us. And there is also the counterfoil of the counter of the Reserve Bank in a situation where it can buy. Because there's so much of cash leakage, cash withdrawal, they are having to do open market purchases. So is the borrowing number so big at all? Is it a worry that we are blowing up?
Well, I think there's a number of issues to discuss here. I think the first thing is that we do seem to be in a global economic slowdown. Even this morning we had the China Kaizen PMI numbers that came in at the worst level that they've been since February 2016. It was the largest point drop since the series began again in 2016. What we've seen is a complete change around in the global outlook that's being signaled by the bond markets. 4 months ago, we were looking at US 10-year yields above 340 and people were talking about it going to 4%. And now we're at 260 and heading probably towards 240. So from that perspective, the market does change. I think what is very important is that, as you say, this is the fall in crude that we've had over the last 3 or 4 months has provided a bit of a breathing room. It was only in October that things were looking very different. And if crude had continued rallying at that time, then of course the fiscal picture would have looked very, very different. I think what we've learned over the last 15 years, I suppose, from looking at the global economies, maybe even longer than that, is that when the sun is shining, it is always important to repair the roof, because when the thunderstorm inevitably comes, it probably is going to be a little bit too late. So I think certainly for the first half of 2019, we're looking at a very uneven and uncertain economic outlook. And the picture could change quite significantly. Our view is actually that because of the dovishness of the Fed and the willingness of the central bankers to stand behind the economies of the world, that any dip now becomes a buying opportunity. And for us, that's a different perspective than what we took in 2018, where every rally was actually a selling opportunity.
But even if this dip is a buying opportunity, do you get a sense, Mohammed, that India could continue to underperform emerging markets? Because that's what's happened this month, right? The MSCI Emerging Market Index is up 9%, while India is down 2%. Because of issues like election uncertainty, possible fiscal profligacy, do you see this underperformance continue?
It's very definitely a possibility. I mean, the election is certainly weighing on the minds of a significant number of foreign investors that we've been looking at. I think the risk premium is actually built into the currency more than it is in the equity market when we're looking at things like equity implied volatility. I think the other thing is the positioning. It is very clear that India is the largest overweight market within emerging markets. Certainly the largest overweight positions in terms of stocks are to be found amongst some of the Indian banks. And really what we've seen from the start of this year is a rotation into some of the value names. So, for example, in China, there are a lot of companies that are now pricing in a negative earnings growth to perpetuity. So basically what those companies should do is just basically close the business and put the money into cash. Now, clearly, they're not as bad as that. The earnings are still growing in those companies. And what has happened is there's been a rotation from India into Hong Kong and China. And, of course, what that's doing is squeezing positions right at the beginning of the year and causing a squeeze. But this is basically what we're seeing across all the markets, which is all the over-owned positions are getting unwound. All the under-owned positions, the most shorted stocks, the value names, are all seeing a bid at the moment. And if we are correct that bond yields are actually heading lower, then what we are seeing is actually buying coming into names where you've got a very good dividend yield story, as well as some semblance of growth. And unfortunately, more companies in North Asia fit that bill than they do in South Asia. But don't get me wrong, we're not actually that bearish, unless there is some negative news around the election, which probably makes today quite a significant day.
No, that point is well taken, and that's the risk factor. You know, the India versus China trade, a lot of people believe could be reversing. But Hugh, coming back to you in terms of portfolio positioning, your thought process last year was all about defensives. IT and pharma, IT in particular, did very well. We've started to see some bit of buying in in big banks, some buying in capital goods. But one sector which has seen quite a bit of derating is autos. Your thoughts on how to position among individual sectors in India?
Well, broad brush, for us looking at India, it has been valued as a growth stock itself, which of course in part accounts for its poor performance in a period when growth stocks generally are being pulled back. And then within India itself, our focus is really on quality businesses, and that means businesses backed by strong balance sheets. I mean, sadly, due to valuations, those businesses don't boast terribly high yields, but at least they boast rock-solid business foundations. And then within that, we're looking at which sectors will drive the markets. And we've got a bit of exposure to, broadly, the auto sector through Hero, but it's not a sector that particularly excites us.
Okay. Well, just a final question to you, Hugh. What about financials? There has been a thorough cleaning up of the banking system. NPAs have been recognized and provided for. Do you like banks like Axis and ICICI? Would you even venture into the public sector banks, a large one like SBI, which also has seen a thorough cleanup, and even the non-banks? How do financials interest you?
Well, we've had decent exposure to the banking sector, but essentially in the private banking sector, which we still like. So it is the Kotaks, the HDFCs of this world, the ICICIs. We haven't ventured into Axis. We've steered clear, by and large, of the state banks. We have some of the more smaller, sort of the Bandhan, GRU camp. So it's really, as you see there, the quality end. And frankly, one of the issues of India is the banking system. It needs to be tidied up. Banks need to be merged and some disappear. But again, that's in the realm of politics.
Oh, yes. So we are going to ask all those questions to a political leader who's just waiting by. And so we thank you, Hugh Young and Mohammad Apabai, for joining us on what's a very important day for Indian policy making and for the Indian economy. Mohammad Apabai, Hugh Young, thanks a lot.